Hey guys, very big news this week as regards the housing market and where it's headed in 2023. To jump right into the top headline, Redfin's market data that came out Thursday notes early stage demand up notably from October trough. That's a good word. Anyways, we're going to dig into that headline. We're going to dig past that headline. We're going to be talking about what happened to CPI this week because there was a new report. We're going to talk about the Fed rate hike that happened this week because there was a Fed rate hike this week. We're going to talk about how that affected 10-year Treasury yields, which in turn affected mortgage rates, which in turn are affecting mortgage applications, and what all this means for how 2023 is going to start. There's a lot to cover, so let's get right into it. Starting with the Consumer Price Index came in this week at 7.1%. This is lower than expectation, which was about 7.3%. Now, as you know, the Fed has been hiking rates in order to slow down inflation, and inflation is slowing. That's a good sign. That means that the Fed might soon begin to let up on its increases. In fact, let's see what the Fed did this week. So here's a summary that is brought to us by Pensford. Now, I have no affiliation with Pensford. They're a company, they sell rate caps, which is like a financial vehicle for commercial real estate investors, way above my pay grade. But Pensford has the best weekly newsletter about rates and also the best weekly podcast about rates. If you want to listen to a podcast about the Fed rate, 10-year Treasury yields, mortgage rates, go to pensford.com. Download their podcast. It's really genius. Anyways, this was the email they sent out after the recent Fed rate hike, and this is just a good synopsis of the headline. The Fed funds rate, the projection, has grown from 4.6% to 5.1%. So the Fed is saying, 2 months ago, we told you we'd get the Fed rate up to 4.6% sometime next year. Now we're telling you it's going to get up to 5.1. The Fed has also revised their GDP prediction downward from 1.2% to 0.5%. So the Fed's saying, and the economy is going to grow a little slower than we thought it was. They also expect unemployment to grow to 4.6%, whereas their earlier prediction in September was 4.4%. So again, they're saying we expect more unemployment than we announced previously, and they expect core PCE to be at 3.5% instead of 3.1%. Now, these two are very important because essentially the Fed is saying GDP is not going to grow as fast as we thought, and unemployment is going to grow more than we thought. In other words, the economic outlook is worsening. Now, this is important. This is very important, and I'll tell you why. In addition to doing this, the Fed raised the Fed rate half a point, 50 basis points. And what we have been told by a lot of YouTubers is that as the Fed rate goes up, mortgage rates go up. But you see, it's not quite that simple because in the same breath that they raised the Fed rate half a point, they also said the economic outlook is worsening. So what happens when the economic outlook is worsening? Investors flee to 10-year Treasuries because 10-year Treasuries are extremely safe investments. And as 10-year Treasuries become more expensive, the yield goes down. I'm making a whole video about this. I hope I can drop it before Christmas, but I'm really going to go into explaining how the 10-year Treasury yield works, how the Fed rate works, like what they actually are. So if you're interested in learning about that, subscribe. But as you can see, the 10-year Treasury has been falling since about October and now is right around, what's that? Oh, my pen's getting in the way. What do we have? 3.5%, 3.5% is where the 10-year Treasury yield is right now. And as the 10-year Treasury yield drops, so do mortgage rates. Mortgage rates are tied to the 10-year Treasury, not so much the Fed rate. So even though the Fed rate has continued to grow in the past 2 months, including this week, mortgage rates have declined. Mortgage rates are now at what? 6.13%. This is great. This is obviously great. I mean, you can see how much mortgage rates climbed this year. That's really the dominant story of 2022. Mortgage rates doubled and demand slowed, as you would expect. So as mortgage rates drop, what do you think that's going to do to demand? Well, if we look at mortgage rate application data, we see that, and okay, so in this graph, by the way, this is from the Mortgage News Daily. In orange, we have the 30-year fixed rate mortgage rate. And in this blue area is a purchase index, an index showing how much demand there is for purchase applications, for mortgage purchase applications. And as we see, when rates peaked, applications bottomed. And now that rates are going down, applications are going up. So we've actually seen 6 straight weeks Well, I guess there's a little dip right here. But the trend for the past 6 weeks has been that mortgage applications are coming back. So what do these forward-leaning indicators say? A couple things. One, demand is coming back. People are looking around, seeing that rates have dropped from their highs, don't think they'll drop a ton more, and are thinking, I think it's time that we complete a mortgage application and start thinking about buying January, February, March. Mortgage applications usually lead purchase data by 60 to 90 days, because that's typically how long it takes from applying for a mortgage to actually buying a house. Secondly, what this tells us is that next year is going to be dominated by mortgage rates. Mortgage rates are going to determine next year's market. Right now, mortgage rates are 6.1%, and it appears to have provided some stabilization to the market. Demand is coming back. Inventory is going up, listings are still very low, but demand is coming back. The market is beginning to stabilize. This is healthy, this is good. We don't want prices to climb too fast or fall too fast. We want a nice, stable housing market. So the big question going into 2023 is, where are rates headed? I'm gonna make a video about this, but the long story short is, right now we have the 10-year Treasury yield at about 3.5%, right? And we have the 30-year fixed rate mortgage at about 6.1%. That spread is around 280 basis points. The average spread between the 10-year Treasury yield and the 30-year mortgage rate, the average spread is around 160 basis points. So right now we're operating at a much higher spread than we should. As the future of the economy becomes more clear, as investors become more comfortable with what's happening, the spread between the 10-year Treasury and the average 30-year mortgage rate is going to shrink back to its norm of 160 basis points. That means downward pressure on mortgage rates. And since the Fed is now projecting an unemployment rate of 4.6%, that feels a lot more like a recession. The Fed is also going to start putting on the brakes on their rate increases. Right now we're at what, 4.5%? 5.1% is probably actually the peak. So both of these are both providing downward pressure on mortgage rates. Mortgage rates will be in the 5s next year. This is my first forecast for 2023. We will see mortgage rates in the 5s and probably under 5.5%. I think we will see mortgage rates under 5.5% in 2023. And when mortgage rates get to that level, it's going to be incredibly stabilizing. All right, thanks for listening to this rant. I know it was a lot. I know I was talking really fast, but I wanted to get through this. This is very exciting stuff. I got more videos coming up. The president of Altos Research just released his forecast for 2023. I'm going to get into that. I'm also, like I said, making a video about rates, how they work, really explaining what the Fed rate is, what the 10-year Treasury yield is. These are terms that a lot of YouTubers throw around, and honestly, I think most of them don't know what they're talking about. So we're going to explain it all so that you can understand. Subscribe and like if you want to see more. My name's Jon Schwartz, and I love you.